What's going on, investors, and welcome back to the channel. I thought I'd do something slightly different today, momentarily moving away from the more in-depth stock analysis videos that I usually do and moving toward a slightly more fun concept of 10 stocks that I think could 10x in the next 10 years. Now, needless to say, right, but I'm not going to be delving into any great detail in any of the stocks, but I want to provide a more Peter Lynch style elevator pitch on why these stocks could be long-term winners. Now, before we get into the 10 stocks, I want to provide a little bit of perspective. Now, I know that the vast majority of you will know this anyway, but a stock to 10x in 10 years is far from a normal or to be expected scenario. A 10x return in 10 years is the equivalent to a 26% compounded annual growth rate, and the historical average CAGR of the S&P 500, depending over what time period you cover, is around 9%. But even within that number, many stocks will fall far below that average, and it's really only that high because you have a small number of stocks that have contributed to a significant amount of the gain. And that can be explained with some really simple maths, in that the most a stock can fall is, of course, by 100% down to zero, but a stock can gain, in theory, an infinite amount. Of course, identifying those stocks is always the most difficult challenge. The second point I wanted to make was that in trying to identify stocks that will provide significant outperformance against the broader indices, you often have to envision what will be different about the world in 10 years' time compared to today. And in doing so, you take on additional risk. It's unlikely you're going to experience significant outperformance by investing in a relatively low-risk stock or sector which is subject to very little disruption. An example being supermarkets, right? So say Walmart, for example. Walmart as a business and the way that we shop today is unlikely to look all that different to the experience 10 years from now, much in the same way that it looks almost exactly the same as 10 years ago. And if you're wondering what Walmart has returned over the last 10 years, including dividends, well, it's about 10% a year, in line with the S&P 500. Now, it goes without saying, but as a result of having to take on additional risk in identifying these 10-bagger potential stocks, you have to accept that you'll be wrong most of the time. The great thing, however, is that you only need to be right a small amount of the time to outperform. This table here shows a hypothetical scenario where an investor evenly spreads $10,000 between 10 stocks. Just 3 of those turn out to be good choices, with the remaining either not returning a dime, losing 50% of its value, or going to zero. And the portfolio still outperforms a historical average. So with all of that in mind, we're going to work down the list from the highest market cap to the lowest. Now, obviously, from a straight up mathematical perspective, right, the smaller the market cap, the greater the potential. So in theory, this should get more interesting the further we go down the list. Anyway, stock number 1 is potentially one of the most hated stocks out there, Meta Platforms. But before you leave, hear me out, right? So Meta currently trades at $500 billion market cap. So I guess to claim that it could reach $5 trillion in 10 years might feel like a bit of a stretch. But you need to view Meta as having 2 separate businesses. One is the family of apps cash cow that generates net profit north of $50 billion a year, and the other is Reality Labs, which is in its infancy and is losing $10 billion a year. If the metaverse does end up being a thing though, I've no doubt that Meta Platforms will be at the forefront of that. You don't have a team of incredibly smart people investing $30 billion a year in capital expenditures and a further $25 billion a year in research and development and not end up as the market leader. That scale of investment is absolutely huge. Now, a lot of people are negative about the metaverse because, well, I don't think that they're seeing the bigger picture, right? They only imagine these weird virtual rooms full of avatars being played by a bunch of recluses. And I agree that I don't see the appeal in that. But what about a use where people from all across the world can watch their favourite sports team in a fully immersive experience and feel like they're really there in the stadium without having to spend the thousands of dollars or pounds or whatever actually getting there? It's far from a sure bet, but I can definitely see the potential from the metaverse, and if anyone can get there, well, then it's probably Meta. Now, analysts expect 2026 EBITDA of $107 billion, and let's just imagine for one moment that the metaverse actually works out, and thus they compound that EBITDA even further by 15% a year from there, reaching $215 billion by 2031. They need an enterprise value to EBITDA multiple of 23 to be valued at $5 trillion. It's by no means a guarantee, but I don't think it's outside the realms of possibility either. Now, the second stock on the list is Alibaba, which is, I guess, potentially the second most hated or divisive or polarizing stock on the stock market, but I promise not everyone or not every stock on this list is that way. Now, there's no doubt that Alibaba does carry significant risk, right? Primarily relating to their VIE structure, meaning shareholders don't actually own the assets of the company, but instead they own a contract to the rights of the profits, as well as geopolitical risks, both of which I've discussed at length on this channel. But these risks have always existed, and Chinese investments have always gone through these cyclical periods of exuberance and extreme fear. and the current period really is no different. In fact, the Chinese government have just announced that they're going to step up their support for capital markets, and Chinese tech stocks rallied by over 30% in a single day. The truth is, though, that while some fear continues to persist, Alibaba carries a lot of potential with all of the different verticals that they've been investing in, from core e-commerce to cloud to digital media and entertainment. Not to mention that the Chinese economy is one of the fastest growing economies in the world. Now, fundamentally speaking, we're talking about a business that is forecast to generate EBITDA of $50 billion by 2026, and applying a 15% growth rate to that gets us to $100 billion by 2031. You're then only looking at an enterprise value to EBITDA multiple of about 20, which is way below the historical average of 35, before you find yourself a 10-bagger. Now, sticking with the theme of e-commerce, the next stock on the list is Coupang. Now, Coupang is the largest online marketplace in South Korea and continues to grow at an incredible rate. Despite that, the stock has had a poor start to public life, IPOing at $49 and now sitting at just $19. It's lost 70% of its value now with a market cap of just $30 billion. With that being said, in 2021, revenues grew 54%, benefiting from COVID restrictions, and 2022 and 2023 revenue growth is expected to remain strong at 26 and 24% respectively. Now, e-commerce is clearly only going to continue growing all around the world, and analysts have the company making $40 billion by 2025. Personally, though, I think that the true success of the business would come from them venturing into other regions such as Japan and making significant inroads there. And if they can do that and achieve just 15% revenue growth from 2026 onwards, that could see them land at $90 billion in revenue by 2031, and a price to sales ratio of 3 would see them hit $270 billion in market cap. Now, a price to sales ratio of 3 isn't extremely cheap, but it doesn't seem too unlikely for what would likely be the dominant player in East Asia e-commerce. So the fourth stock on the list is priced at $29 billion, and that company is Twilio. Now, Twilio is one of those companies where it's kind of difficult to simply explain what exactly it is that they do, but basically they help organizations and brands engage and communicate with their customers through APIs, which might not sound all that exciting or valuable, but they also have a world-leading customer data platform called Segment, which empowers businesses to capture and analyze first-party customer data. In an increasingly data-driven world where businesses need every edge that they can get, Twilio are primed to take advantage of the competitive landscape, and that's already showing up in their financials, where they grew 63% in 2018, 75% in 2019, 55% in 2020 and 61% in 2021, where they posted revenue of $2.8 billion. Analysts have them at $10 billion by 2026, and I personally think that they could reach $30 billion by 2031 as they continue to scale their business. EBITDA margins are currently around 10%, but if within the next 10 years they can increase those to 35%, which is still relatively low for a software business model, they would only need an enterprise value to EBITDA multiple of about 25 to see a 10x return over 10 years. Now, stock number 5 is one that is very popular here, and that is DraftKings. Now, about 6 months ago, I made a video saying I really didn't like the valuation of the stock when it was sitting at around $60, and I thought that GNOG was much better value. About 2 weeks later, DraftKings announced that they were acquiring GNOG, which I then reiterated that that was good business for both stocks. Today the story is different though. The valuation has come back down to earth at $19 and is valued at about $8 billion. Now, the bull thesis for this one is very, very simple. In the long term, I'm very confident that sports betting is going to be huge in the States. It's huge here in the UK, and Americans are just as mad for sports as we are. Yes, they spend a lot of money today on customer acquisition, but the lifetime value of customers is way bigger than that upfront investment. And more mature states such as New Jersey have demonstrated that the business model is actually profitable. 2021 revenue was $1.3 billion, and analysts are already penciling in 2026 revenue of $4.5 billion. And I think that they can double that again and hit $10 billion by 2031. If they can hit 35% EBITDA margins by 2031, which isn't that high considering EBITDA margins are expected to increase from 8% in 2025 to 14% in 2026, you're talking about an enterprise value to EBITDA multiple of just 20 for close to a 10x return. I definitely think that this could be a good one to watch. Now we're starting to get onto some of the small cap businesses. And stock number 6 is Canadian Solar, which, as you can probably work out from the name, develops and manufactures solar modules and solar powered products. The rationale behind this selection is that it's clear we need to transition to more renewable forms of energy, and this trend is only going to increase as more and more pressure is put on governments to act. And there is no larger single source of energy than that is provided by our sun. It's just that at the moment the products we have aren't all that efficient in actually harnessing that energy. Over time though, this will only continue to improve. Now, ever since March 2020, energy stock valuations have gone through the roof. But actually, Canadian solar has remained fairly reasonable. It's currently valued at $2 billion, though they do have a large amount of debt, so their enterprise value is actually $4 billion. But 2021 revenue increased by 52% to $5.3 billion, and analysts are expecting 2026 revenue of $8.3 billion. Now, if revenue can grow at just 10% per year thereafter to reach $13 billion by 2031, we're only talking about a price to sales ratio of about 1.5 for a 10x return. The seventh stock on the list is Darktrace, which is a £2.8 billion company headquartered in London that engages in the development and sale of cyber threat defense technology solutions. As the world becomes increasingly dependent on technology, which is a trend that is clearly only going to continue, companies operating in this industry are poised to thrive as the total addressable market continues to grow. The total addressable market of cybersecurity is expected to grow from $165 billion in 2021 to $366 billion by 2028. Now, Darktrace is really only just getting started, posting revenues of £281 million in 2021, but analysts expect them to generate revenue of £900 million by 2026. With a company like Darktrace in such a rapidly growing total addressable market, I actually wouldn't be surprised to see their revenue growth accelerate over the following 5 years rather than decelerate. But let's assume their revenue growth remains consistent at 30% a year. That would put them at £3.5 billion of revenue in 2031, requiring an 8.5 price to sales ratio for a 10x return. Now, listen, I'll be the first to admit that banking on an 8.5 price to sales ratio 10 years out is way too optimistic. Even if similar but much larger companies like Palo Alto Networks trades at 12 times sales and is a $55 billion company. Therefore, I'll caveat this with, I think the valuation is high, but I can also imagine a world where growth is higher than I've outlined in this hypothetical framework. Now, stock number 8 is Fiverr, which operates as an online marketplace enabling individuals to sell their services, basically capitalizing on the ever-increasing gig economy. Now, for many years, large companies have been outsourcing their work out of the West to cheaper regions around the world, where people are able to perform the same quality job, but at a fraction of the price due to differences in living costs. Fiverr is now working on, and has been achieving, on bringing this practice to the broader population, as well as small and medium businesses, not just the large conglomerates. I think that the gig economy is going to continue to expand, and I think that Fiverr have already developed a fantastic brand to try and capitalize on this trend. Now, as you'd expect, following the pandemic, Fiverr stock got way ahead of itself, rising all the way to $320 in February 2021 before losing over 80% of its total value. It currently trades at $2.7 billion, which, if I'm being honest, is still a really rich valuation at almost 10 times sales. However, the business is rapidly growing and is expected to record revenues of almost $800 million by 2025. And if they're able to continue growing at 20% a year thereafter, they'll see revenues of $2.4 billion by 2031. Now, granted, Fiverr are currently unprofitable, but I think that they will follow the typical software business model, which is that whilst initial setup costs are high, economies of scale means that margins tend to increase as they grow rather than decrease like we see in many other businesses. Now, analysts are expecting EBITDA margins of 16% by 2024, and I think that 40% by 2031 is definitely possible, and that would put them at EBITDA of $960 million. A 25 times enterprise value to EBITDA multiple, which might seem high, but remember we're talking about a profitable business continuing to grow at 20% year on year. That would see them valued at $24 billion. Now, stock number 9 is Asos, which is listed on the London Stock Exchange, operating as a global online fashion retailer, selling not just its own brands, but also third-party brands as well. Now, Asos is a stock that has had a really tough time over the last year, with a 52-week high of £60, currently trading at just under £18, giving it a market cap of £1.8 billion. Now, Asos have a fantastic track record of growing the business. Revenues have consistently grown for Asos, going from £223 million in 2010 right the way up to £3.9 billion by 2021, meaning it currently trades at just half its total sales. Now, one of the things that I really love about Asos is that they have a very customer-centric business model, much in the same way that Amazon do. And they were probably one of the first online fashion retailers to offer no quibble free returns on absolutely any item that they sell many, many years ago. Now they're guiding for revenue of £7 billion by 2025 and are now investing heavily in automating their warehouses to improve operational efficiencies, which should assist with increasing net profit margins back within the 5% region in the long term. If they can increase revenues of £7 billion from 2025 by 15% per year, that puts them at £16 billion by 2031. Applying a net profit margin of 5% to that, we're talking about £810 million of profit per year. Now, a PE ratio of 20 then takes us to a £16 billion valuation, or a 10x from the current levels. A conservative PE ratio of 15 would mean a £12 billion valuation, or a 7x from the current price. And I suppose this is the point where I say that the title of 10 stocks was maybe a little bit of a lie. There were various other stocks that I could have chosen, but I don't think that they fit the overall theme quite as good as the 9 that I've mentioned. So rather than try to shoehorn in another selection, I'd rather just leave it at 9. Now, unfortunately, 9 stocks that will 10x in 10 years doesn't quite have the same ring to it. So I'm going to leave it at that. Anyway, guys, I hope you've enjoyed the video. Don't forget to like and subscribe, and I'll see you in the next one.